Okay, I hope everybody's having an enjoyable All Hallows Eve tonight, heading into a very, very important week, especially with the FOMC. It appears like the markets kind of said their piece and counted to three last week, and now they're kind of done, right? Now they're not doing anything. Very small range today, probably will be tomorrow. It's all about Wednesday. It's all about, and then after that, jobs numbers, and then after that, inflation. There's always something, but it seems like the markets over the last week or so have been really pricing in what they think will happen on Wednesday, what will be announced, and then now it's a matter of will we actually get that. The market's got a recent history of trying to front run inflation reports and earnings and all of that, and hasn't done a very good job of it. And they've done it again here with a tremendous rally. Enough of a rally to produce some really good bullish signals that otherwise would be bullish enough to get us going, come off of a correction low and get us going to the upside. Which very well still may be the case if we get, from the market standpoint, if we get the buy-in from the Federal Reserve. So that's what we're waiting for on Wednesday. I'm going to break down what the market looked like today and what some of these. We had some pretty interesting moves in different asset classes today, which you wouldn't have expected. We're going to break down some of these other indicators as well in terms of the volume and the breadth, that theme we've been talking about since Friday. And then our trade idea is a stock that may be butting its head up against a very significant resistance and how to trade that. So let's go ahead and get started. Today is October the 31st, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get started, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon down there to like the video today. Comment on anything that stood out to you. Join our website on MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching here on our blog, check out some of these things over here on the right. Come down to the bottom, click that heart. We got 87 likes. Good job, everybody. Let's see. Again, goal is always 100. Try to get up to 100 there. If you're watching right now, just go ahead and click on that. Opens up this tab, hit that like button. Same thing here with the thumbs up icon. Click on that, hit that like button. Again, you can do that right now or anytime while you're watching. Helps us helps push our content out to everybody who follows us on these social media platforms. Also wanted to give a shout out to Catherine here for the super thanks. We really appreciate that. Again, I understand it's a small number, but it's very meaningful. Again, it's the support that matters, and we appreciate all of you who watch the videos and all of you who support with the likes as well as with the super thanks. Okay, let's start off taking a look at the S&P 500 with the market forecast indicator, and you can see that we gave back some of Friday's gains, but not very much. It was a very small range, less than half, so very, very small range today. Of course, we all know why. The market's anticipating the FOMC coming up. It will be interesting if tomorrow we end up with a bullish day and close at the highs. Very good chance we end up with a cluster, right? So because your near-term line is already above 80, your momentum line is almost there, 79.5. They're both rising, so they're both going to get there tomorrow, barring a big drop. And then the momentum line again we'd have to get a bigger range than what we saw today, and then, like I said, close at the high. If we can get that, then we might get a cluster going into the FOMC meeting, which is, again, fascinating considering 12 days ago we just had a bearish cluster. So wouldn't be the fastest. I don't think it would be the fastest from cluster to cluster. And like you can see, here was a cluster from green to red, and it took a while, and then we didn't get a cluster over there. Let me go see at least in the last 5 years. There's that cluster again from green to red. Let's see here. You had these clusters. You didn't get a red one over here. Let me get rid of these bear tags for just a second so we can see them. So we didn't get any until we got way over here. So that was quite a bit of time. This one you didn't get a cluster coming off of that oversold. Sold. We didn't get any overbought coming off that oversold, and then no oversolds coming in anticipation of that overbought. So, I guess we could pretty much say, at least in the last 5 years, if we were to get a cluster here, it would be the fastest oversold, overbought cluster that we've gotten, at least in the last 5 years. And we might be able to go back further. Let's just go back in the last 20 years. Again, going back into this area, you can see, this kind of visualizing. This looks like it'd be one of the closest is right here, 2014. We went 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days. They are coming off that Ebola virus low point. You also had, looks like right here, you came pretty close. You got a cluster there, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days there from cluster to cluster. So a couple examples, 2014, 2015 coming off that first one. And then, let's see here, looks like nothing too major. Close to one there in 2012. Nothing significant there in 2011 or 2010. Relatively close, but looks like more than 13. Same thing there in early 2010. 2009, that looks like it took a lot more than 13. We never did get we got one overbought cluster during the false correction. We didn't get a cluster in either the failed pullback or the return move there. Pretty decently fast, but looks like more than 13 days there. Same thing here, same thing there, and in between these. So it looks like there, 2014, looks like here's another one here in 2003 coming out that bear market. 1, 2, 3, 4, 5, 6, 7, 8. 8 days was the fastest coming off that bear market low in 2003. So a few times, but needless to say, it's a pretty fast move. We're at 13 days. This would be day number 13. So we're not going to get it in 13 days. If anything, we'd get it tomorrow with 14 days. Or with the FOMC meeting, because if the market's going to rally on FOMC, it's going to rally big. So we're going to get one. It'd be 15 days if we end up coming out of that meeting with a bullish response in the market. I don't think we'll get a bullish response, but obviously that's the trend right now in the last couple of weeks, especially with the intermediate line rising. Market sentiment still falling, and it's in bearish territory. So, but it looks like it's at least slowing the pace of its decline. And you can see the Nasdaq 100, not quite. So it's lagging behind here. Here, let's just go to the 1-year chart. The Nasdaq 100 is lagging behind. Its intermediate line is not in bullish territory yet, and its short-term sentiment's not up to the upper reversal zone. And you're just barely above the 30-day moving average, so it's not green there. Is it green yet on the SPX? I think it is green on SPX. It turned yellow again today. So turned green yesterday. It's back to being yellow here today. So you have that in the Russell, so lagging behind. The Russell did come really close to an overbought cluster. Now it did not have the oversold here, but it came really close. We were at the 79th percentile, 90th and 83rd. So that 1.08 percentage difference was all that we missed a cluster on the Russell 2000. So this was a lot more bullish, especially over the last 6 days, 7 days here. In fact, again, I've been showing this on some of these charts. If you look at the Russell 2000 over the last 7 days, the Russell 2000 actually rallied here. Let's pull up the Russell. There it is. So the Russell 2000 here, slightly lower but up from the open. So you can see the move, 8% rally here in the last 7 days. So 1, 2, 3, 4, 5, 6, 7. Yeah, 7 days. You're up 8%. This again kind of mark that number as 8.35. It looks like 8.36 is how far it's been. So that is the highest return of the year for the Russell 2000. It matches the peak of 2021 in October, where you had a really sharp return there that ended up setting the peak. And then you can see you had a few peaks here. This is when the Russell went parabolic. So it started off with a parabolic move coming off of the election and the vaccine reports. So you started off with a 13% move in 7 days, and then you finished that parabolic move with a couple big 6-day returns, 6-day rallies there. So really good move. But you notice what's interesting about all these other times is that some of these moves, especially this year, some of these kind of parabolic moves at the end of March and here in mid-August, they included these meme stocks really taking off to the upside. That's not the case right now. Let me put this on a. Let me put this here on a. Let's see. We'll do log scale. Oh, there we go. So you can see like not nearly the same kind of move right now on these. Again, using AMC purely as a proxy for the meme stocks. A lot of these other moves in 2021 that we had those big jumps in 2020 included some big returns for the meme stocks. It's not now. So that's kind of interesting to see how we're not quite getting that big. Because again, you look at this as kind of a reflection of like high-end risk appetite. ARK Investments would be another proxy for high-end risk appetite. And if you take a look, it's had a really pretty decent return over the last few days as well. It's like pretty much anything else. But as bearish as it was, you can see it's still struggling to get above the 30, much less getting above the 50 or the S&P. And it's already, so it's not quite, again, this is the high-end scale of risk appetite. If it's not, if that high-end is not leading us higher, it's actually, if you saw from Friday's video, the safety areas are leading us higher, then it makes you wonder just how bullish we are. Seems like I sound like a broken record whenever we have these rallies, right? All these rallies all this year, it's always been like, well, David always wonders how bullish we are. Because when you look, again, when you look at the McClellan oscillator, we talked about on Friday, we'd like to get above 100. It didn't quite make it today. So we didn't quite get above 100. And again, we're not, you go back to where we were at 600. So we were kind of, here at this level, it is starting to move up a little bit faster, and we feel, a little bit better from where we were. See, that's ARK Investments. Sorry, no wonder. I was going to say we didn't seem like we were that close. So here's where we are. Here's where we were back when the oscillator dropped down here, and this is where we're at right now. So you are starting to move up a little bit. But if you look back at where we are from a price standpoint, the last time we were at this level, the McClellan oscillator was a lot higher. That's what we're missing, right? And again, same thing on the on-balance volume. On the on-balance volume, when we were up here at these levels before, the on-balance volume was a lot higher. So we're missing this rally. You notice, there's not much difference between, where we bottomed out right here and where we're at right now on the on-balance volume. This is the money flow. So this is volume normalized by the price. So when you look at that, it's like, well, dang, we're not as bullish as we've been over the last however many days. We have not gone up very much at all in 13 days. From a volume standpoint, you compare like some of these days, and we were actually a little bit more bullish, or the volume rallied a little bit more. Still not enough compared to what we had, when we had dropped, but at least it went up more. We're not going up very much at all here. In fact, so what that means is on these declines that are kind of interspersed, this one, these two, a couple right here, and then today. So you've had a couple of periods, or 4 periods, 1, 2, 3, 4 periods where you came down, and the volume on those down days, which ended up being 1, 2, 3, 4, 5, 6 days, is just barely less than what it's been on the other days. However many up days, 1, 2, 3, 4, 5, 6, 7 up days. So 13 days, tremendous rally. 7 of those days were up, 6 down, so that's kind of an even split. And then, like I said, because it's an even split, the volume's not overwhelmingly in the bullish direction. And when you look at another breadth sign, in this case, how many stocks are, getting highs and lows. Let's just update this and make sure. How many stocks are getting highs and lows? You're not seeing that here either. You also like to see the skew break above its moving average when you're rallying, because I'll see all these other rallies, the skew is breaking above its moving average. That's not the case right now. So you're still, you still got that issue. The trend, usually when you've got a little bit of a rally in the S&P, the trend comes down, right? You see the trend. We got a rally on the S&P here, right over here. The trend comes down. Well, the trend is actually already down and going up. As you can see, the MACD is rallying. The trend is well above. Again, this is a weak sign of breadth. And then finally, when you look at, not this one over here, this sign of breadth here, and this is the number of stocks that are at 3-month highs, dropped pretty sharply today on a very, very quiet day, but back below 10%. That's not the best indicator when you're coming off of a significant low to not be getting new 3-month highs here. And you can also look, if I were to change this back to the number of stocks above their 50-day moving average. Let's see, let's come back up here. Number of stocks above their 50-day moving average. That's been something we've been looking at too over the last little bit, and this is over the past year. You can see we are above 60%, but I mean, zoom out to the last 5 years, you can see coming off of really significantly bearish levels there, below 20%. Let's chart this last 5-year period. Again, you can see in August we were above 90. We were well above 80. We're barely getting above 60 here. In March, when we had that peak, we got above 70. And you can see some of these other peaks at the end of last year, we were getting above 70. And of course, when we're bullish, we're easily above 70. So the fact that we're peaking here potentially in the low 60s is another sign that we're not quite getting the breadth that we need. Now let's take a look at the VIX. The VIX started off bullish, as it always does on Mondays. Filled in the gap, finished down again below 26. So a bearish drop on the VIX, still up at 96 percentile. And again, it's the VVIX that's the big concern. The VVIX was up today, and this is the concern coming out of FOMC if this thing starts to pop. Because again, if this pops, as it typically does when you've had this big of a decline in the VIX over multiple weeks. In fact, if I were to go off of the this monthly chart here, one of the biggest drops in the VVIX on a monthly chart to finish below 80. When you typically get these big drops, you tend to get some months afterwards that are pretty bullish on the VVIX. And especially considering that we are still already very high in the VIX, setting up for a tremendous move to the upside off of a much higher low point than what we've seen. So that's the issue going into the FOMC, and that's why, again, I'm not too confident about the rally that we have that appears to be slowing down with the inside day today, and more than likely probably going to be an inside day tomorrow too, until we get that announcement on Wednesday. And with the ADP, with JOLTS tomorrow, ADP report on Wednesday, and then the unemployment numbers on Friday also. With the quarterly employment costs index, as well as the unit labor productivity coming out as well this week. So this is a big week, and finishing up the earnings season with what's left after. Now we have the big, the financials and the big tech companies. So now we're going to continue to kind of push through earnings. So a big week. So probably going to be an inside day until we get through the FOMC and then start focusing on unemployment and then inflation next week. All right, now let's take a look at what's driving a lot of this price action. You can see today, the big mover to the upside today was the dollar, and that kept some pressure on equities. Again, very small range, so keep that in mind about the the equities. But large cap, the Qs obviously down the most. Not surprising. Small caps are actually up a little bit, but the Qs were down the most. Yields were higher. Commodities actually were down because of the strength in the dollar. But rising yields and rising dollar, it's not necessarily what we want to see, right? From a bullish standpoint, going all the way back to the 21st, so the last 6 days or 7 days or however many days here, you can see just how bullish that we've been. IWM up 8.5%, continuing with this move, but the weakness in the dollar still, starting to lose some of that weakness, starting to ramp up a little bit. And bonds, which were up, yields are starting to drop. So let's take a look at those charts, and you can see UUP back up above its 17-day moving average. It's still falling, right? But you're back up above the 15, above the 17. MACD is rising, not quite back above its moving average yet. And you look at TNX, and TNX is back up above its 8-day moving average. We talked about, there's not a whole lot of downside that TNX has because it's already inverted with a 3-month and a 2-year. So there's not much downside there. There's more upside because it's got to get eventually to 5% if that's where the terminal rate's going to be. So the market's pricing in. At least the 4 3/4 is pricing in by next February, right? One last, it's funny, the futures market is pricing in something that the Fed's never done before. Slow down or rate increases. But if that's what ends up being the case, the 10-year's got a long ways to go to catch up to where the Fed funds will ultimately be by the time it's all said and done. Now the Fed funds is still below, because the Fed funds right now, it will be at 4% by Wednesday. It will be at 4%, but it will be most likely at 4. There's a 90-some-odd% probability that it's going to be at. Where is it here? There's a 90% probability that it will be at 4% here tomorrow or Wednesday. There's a 95% probability to be at 4.5%, and then a 98% probability it'll be at 4.75, with about a 70% probability it'll be at 5% or higher. So which means the 10-year yield's got to get up to 5%. I mean, that's where it ultimately will get to by the time the Fed's done raising rates. And either that, or we'll have a 100 basis point inverted yield curve on at least a 2-year, if not the 3-month too, which would be, it's rare for the 3-month 10-year to be inverted at all, just a little bit, but for it to be, 25, 50, 100 basis points inverted, if the 10-year doesn't go up to 5%, that's, for the 2-year 10-year to be at 50 basis points, that's a big inverted yield curve. If you come over here and come to the yield curve here, that's a big inversion at 43 basis points. If I were to zoom out, you can see as far back as this goes back to it looks like the early 80s. That's a big inversion. You have to go back to the 70s to get an inversion on the 2-year. That's as low as we got right now. And if the 10-year doesn't get to 5%, you're looking at that even being bigger. So it's a very telegraphed move, and generally speaking, that should, especially considering that we are the most hawkish central bank global, at least among all the major economies, that's going to push the dollar higher. It's going to push yields higher. Kind of defeats the purpose of the bullish narrative that's been fueling the stocks rise, right? With the dollar pulling back and yields pulling back. The dollar never even started to retrace, or it just pulled back 23, and that was it. Never even started to retrace. And the 10-year, as you can see, since it started to really take off here on a long-term basis, not even close to getting to its 23% retracement. The TLT, which would be the inverse of this, right? If I were to zoom out a little bit here, so you can see when that started to decline, actually in 2020, but it really started to decline right here. If I were to activate this and pull it up to this level, let me do this again. Bring it right here. So if you look at that again, we're nowhere near. Here, activate this. We are nowhere near getting to its 23% retracement, and even starting to retrace, right? Much less a trend back to the upside. So I think that's why it's a little. We're just a little too. The market just doesn't do a very good job at front running things, and I think the Fed's going to come out most likely, not tomorrow obviously, but then Wednesday, and pretty much say that we shouldn't be as bullish as we are, and the market shouldn't anticipate the pivot or the pause or the step down as much as they are. That we'll continue to keep rates as high as we need to. We'll get in and keep them there at these really high levels. And again, how high will they get them? They've said that they've talked about the policy error of the 70s, where because of political pressure right here in the mid-70s, they did not get the real Fed funds rate positive. They stopped. they actually started cutting rates, and that kept inflation. You ended up, because of that, you ended up with a double dip of inflation, right? So Powell specifically mentioned this, right? You got inflation coming down, so they stopped raising rates. They didn't get the Fed funds rate the real Fed funds rate into positive levels. They kept it right there because they were pressured, and they admitted so much, right? And then because of that, they ended up with a double peak of inflation that eventually Volcker had to come out and say, okay, we're raising rates to 5%, real rates up to positive 5%, and then they left it there positive 5% for 6 years. Right? That's what Powell has said. Now Powell says ideally they hope to not have to go as high and leave it as long, because the reason why they had to do that, in Powell's words, was the policy error they made here in the mid-70s. So they're hoping that they can get up to, these levels like they did before the last two recessions, positive 2.5%, and get it there, because they didn't do that in the 70s. But if they can get it there now, they won't have to go as high, and they won't have to stay as long. That's not necessarily the message the stock market is hearing or wanting to see, but it might be the message that Powell reiterates on Wednesday. All right, so for our trade idea of the day, I wanted to take a look at Home Depot. So let's pull that up here. You can see Home Depot has also benefited in the last 6-7 days. It came off of a lower low point. The market, remember, it came off its low here 13 days ago. But Home Depot has really had this late push in the past 7 days, and brought the intermediate line out of bearish territory. It's up in the 90th percentile. The near-term line kind of setting up a little bit of a near-term divergence here, and momentum line in neutral territory. So, obviously bullish, dark green shading in a green line. You're going to have bullish signals all across the board here on Home Depot. Obviously you have, green arrows here, though you're still in a death cross environment. When you look at the 3 green arrow chart with the 2 lines, you can see you're above the 50-day moving average. Great, but you're in between a gap between the 50 and 200, which is not so great. And within that gap, you've got the point of control and a big volume node above that. Those are both resistance levels, and they're very strong resistance levels. And then you're getting this Harami pattern here today with that MACD peaking. So that's the issue. You're also at the top of the Ichimoku cloud, right? You're not going through the cloud. You're still in it. You don't have a trend developed here as bullish as we were over the last little bit. When you look at the Bollinger Band width, we are rising. We did get up above the Bollinger Band, but we're not really pushing anymore. Pushing that band out, as you can see when you look at that with the Keltner channels. You're not above the Keltner channel yet. So you got above the Bollinger Band, but you did not get above the Keltners, and they're not expanding out yet outside the Keltners. So we're not really breaking out here. Home Depot, we're back below 60. We're coming back, here with a divergence on the CCI. So with that being said, especially considering out some significant resistance levels, I decided to come over here to December and just do not buying at the money, but buying one strike away, and then shorting the 285. So it sets us up for, with a half my normal position size, almost a 2-to-1 reward to risk ratio. Again, similar to other trades where if it doesn't work out, we can just close out early. We did that with the Goldman Sachs position here today in the Market Outlook Live session. We closed out that long put vertical in Goldman Sachs with a couple $100 loss, which makes it out to be about a 4-to-1 reward to risk ratio. If we can keep our risk ultimately to that level instead of letting it go all the way to max gain. Max gain would be fine, but if we get out early, you can see what a difference that makes in terms of reward to risk. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread or with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video down below. Join our website at marketscholars.com for free, like I showed you earlier. Like us on Twitter and Facebook. Have a great rest of your Monday night and Halloween evening, everyone, and we'll see you all next time.